Hello and welcome to this very special Indianomics, where we are going to celebrate actually the state of the economy. India's GDP growth in the fourth quarter has raced ahead of estimates. The growth has come in, GDP growth has come in at 7.4%, well above the CNBC-TV18 poll of 6.85%. With this, the growth for the full year has also been upped to 6.5%. Our forecast was 6.3%. Now 6.5 was the central government's target. There is a lot more to celebrate in the full year numbers. If one looked at the way in which capital formation has maintained its pace, the way in which private final consumption continues to be robust at 7.2%. I mean, we were all cribbing about urban consumption. For the full year, a 7.2% is a damn good number, you will have to say. And even for the quarter, the private final consumption expenditure at 6% is a fairly decent number. Of course, capital formation has done even better. To take us through the numbers, we have a panel of experts: Kaushik Das, the chief economist at Deutsche Bank; Subodhi Prakshit, the economist from Kotak Institutional Equities; Abhishek Upadhyay, senior economist from ICICI Securities PD; and Aditi Nair, chief economist at ICRA. Aditi and gentlemen, thank you very much indeed for your time. I know some of you are personally very pressed, and I'm deeply grateful that you all have made time in spite of your personal engagements. Kaushik, I'm going to start with you. First cut, what's the key takeaway from Q4?
So Lata, I did a show with you about the expectations of GDP as well, where I highlighted to you that the risk is to the upper side. And, we had a forecast of 6.5% for GVA and 6.8% for GDP. But I wrote in my report clearly that the risk of, getting a 7.5% GDP number is very high, given that, subsidies have contracted by 45% in January-March quarter. So GDP, I'm not surprised. But if you look at GVA, we were expecting that momentum to improve to 6.5 from 6.2. But we see that October, December has also been revised up to 6.4. So from 6.4, we have gone up to 6.8. And it is quite a good, momentum if you think of it, what was happening 2 quarters before that. So I would say overall, it's definitely a positive surprise, not just from the GDP statistical point of view, but even from the GVA point of view, that we are close to 7% in January, March of 25, which very few people would have expected.
Yeah, I agree with you, Kaushik, that very few people expected. After I finished my poll, I got a lot of numbers north of 7. Within the poll, I got 7.2 as the best number, and that was from Abhishek. So Abhishek, over to you. It is still better than what I would have considered optimistic estimates in my poll. You tell me what did you take away? As Kaushik points out, probably everybody was expecting an upside surprise on GDP, although they gave me their stated number. Everyone, like Kaushik, told me there is an upside surprise because the subsidies number is very small. So I wanted to ask you what you meant, what you made of the GVA number as well, which has come higher than your expectation of 6.5.
Well, Lata, so numbers are very close to what the government had estimated at 6.8 and 7.6 when they put out the second advance estimate. GDP at 7.2, we were predicting GDP at 7.2%, so slightly higher. Also, GVA at 6.8 compared with 6.5 we were penciling in. Most of the surprise coming from construction sector on the GVA side, which has grown much strongly, not just in the last quarter, but even in the third quarter, where the growth data has been revised higher slightly. Big picture, the fact that government spending is estimated to have contracted 1.8% in the Jan-March quarter versus government's earlier estimate that it would have grown something like 4%, and still we got similar headline numbers, indicates overall better underlying momentum than what we were thinking. Still, the big picture view still is that perhaps growth is not as strong as the GDP number indicates, and perhaps it is not as weak as what the first half growth was at 6%. It's likely that underlying growth would be somewhere in between at 6.5% or so in our view. That is because last quarter, again, there was a big surge in government capex, which has pushed up the overall gross fixed capital formation number very strongly. That was growing at around 9.6% in the Jan-March quarter. That growth will not sustain, but a normal level of government spending and a reasonable agriculture growth next year should still mean that we get a number somewhere around 6.5%. We are slightly lower, mainly because of risk from the external sector front.
Okay, come again. You're saying that there is a chance you will revise your current year's number?
We are at 6.3%, Lata, but that is mainly because of the risk from exports. From the consumption and capex growth outlook standpoint, we broadly expect growth to more or less flatline in the current fiscal year. The big question is how big the drawdown from exports is. As you would know, exports was the key driver of growth in the recent years in the COVID period because advanced economies gave a lot of stimulus and we benefited from these exports. Exports could slow down this year. Just that we have two buffers here, if I may point out. One, services exports is a key driver of our overall exports and they can be more resilient even if global goods trade slows down. And second, commodity prices have declined, crude prices are lower, and that offsets some of this drag from weaker exports. Therefore, we are slightly lower than 6.5% at 6.3% in terms of our growth forecast for this year.
Okay. I can understand that the global headwinds are keeping everyone a little wary, but the kind of gross fixed capital formation that we are seeing clearly should throw up greater productivity and output in the coming quarters. And private final consumption as well in the fourth quarter has grown by 11%. I mean, we were all worrying that urban consumption may have stalled and it's only rural consumption. But the gross macro numbers are clearly indicating that private final consumption expenditure has actually done very well. Government has lagged, but it was always expected to. Sudeep, what would you take away from the consumption angle, from the expenditure side of the data?
So, Lata, I think one point that I would like to mention is that if you look at the third quarter, that print has been revised. So yes, the third quarter data has been revised. And hence, if you look at a momentum-wise, the fourth quarter number, that obviously moves up. So I think the difference between a 6.8 or a 6.4, 6.5 that we would have been expecting, I think much of it would be covered with the revision that we see on the third quarter front. However, and coming back to the point in terms of the consumption versus the investment side of things, I think the investment growth has been a very good print in that sense at a 9.4% in the fourth quarter. And that is reflective of the fact that there has been, the government has spent a lot in terms of the capital expenditure. This was a kind of a pent-up spending that was there, transfers to the states, etc., which went in the last quarter. Consumption, I think, and my view has been that consumption continues to be on a weaker footing. 6% growth after 8% growth in the third quarter is not something that's extremely strong. It's mostly being driven by the rural and a bit of the informal or unorganized segment. Urban consumption is still weak, and I think the 6% is kind of symptomatic and kind of reflecting that fact. And I think going forward, there should be a cyclical pickup, some moderate pickup that we should see in the urban consumption. But the fourth quarter number is not reflecting a strong consumption growth as such. It's mostly being driven with the investment side of things.
Okay, but the number I get is pretty strong, isn't it? If you only looked at the PFCE, it is 51.38 lakh crore compared to 46 lakh crore. That's a growth of about 11%. You're still not impressed?
Sorry, Lata.
Private final consumption expenditure.
No, so what you're seeing is, I think you're looking at the current prices. Okay. That's the nominal GDP. Okay. If you look at the real GDP or the real...
Sorry, yeah, go ahead, yeah. If you look at the real number, perhaps it's a different...
It's a 6% growth.
Okay, I'm sorry. I was looking at the wrong table, too many numbers. Aditi Nair, your thoughts. Are you convinced that now you may have to revise the GDP numbers upwards?
So, Lata, let me put it this way. We were at a 6.9% GDP growth for this quarter, and the upside surprise is equal both for the GDP and for the GVA growth numbers. So, it's an interesting quarter. Both are 50 basis points higher than what we would have thought. So, it's not that the net indirect taxes has grown faster and therefore there is a large wedge between the GDP and the GVA growth numbers. The wedge is the same as what was expected. However, when we compare the sequential quarters, you've got GVA growth going up by 30 basis points to 6.8%, which is a good number, no doubt.
Yeah.
The GDP growth is going up to 7.4% from 6.4%. So that's where, the dissonance in terms of how solid the growth numbers are.
I get you. I get it. I mean, that's exactly what Subhadeep is also pointing out. In a way, he's only looking at since I asked him about consumption, if you look at the momentum from Q3 to Q4, it's not looking very great for consumption and it's not looking very great for growth, is what you're saying. You're therefore not going to, even from 6.5 going up to 6.8 is not a bad momentum, especially if you look at it from the second quarter. Second quarter GVA is 5.8, third quarter 6.5, fourth quarter 6.8. It looks like you're in the right direction, aren't you?
Yes. So my view is that when we look at the private final consumption expenditure growth over the 4 quarters, there is a lot of oscillation. You've got like a 6%, then an 8%, then back to a 6%. So this has been a very uneven year, even on a quarterly basis. Forget about the rural urban, which we keep talking about, that unevenness. Now, on the discrepancy side, also the numbers are quite odd. So typically when we get the first round of the expenditure side data and the discrepancy number moves a lot, we tend to expect that there will be large revisions going ahead. So some things which may not really be clicking very well with what we feel the narrative that we have for how the economy has been, it could well turn out that the revised data will be closer to what we were thinking before this set of information came out. So, for instance, I did not think that this was a quarter where there was such a strong momentum in the investment side. There again, the high frequency indicators were pointing to quite a lot of unevenness. So I think, some of these things, maybe the revised data will be more in line with what we were thinking.
Yeah, no, revisions obviously make us rethink a lot of numbers. But I wanted to invite your attention, Kaushik, to net exports also. That has done extremely well. You just look at the imports number, that's fallen by 12.7% year on year for the fourth quarter, whereas exports have grown by 3.9%. So net exports clearly has contributed. Do you think that is one big point to note?
So there are a lot of data issues about double deflator and all, how imports are calculated. But generally, if you see the last few quarters, the net exports contribution to GDP is quite positive. And, that's why we have got a GDP number close to 7.4 even in this quarter. Yeah. But Lata, the point is, if you cut through all the noise, real GVA growth is at 6.8. RBI, for all its worth, would be looking at the headline number and, reacting on the basis of those numbers. So I think 6.8 is a very good number compared to the last few quarters when people thought that India's growth has gone very low and we are much below potential. A 6.8% GVA growth is pretty good. And as I told you in the previous show as well, that we are not as pessimistic, like others for FY26 growth. Our growth forecast is 6.5, and I'm telling you, probably there could be upside risk going forward, also because of a technicality of GDP deflator, where this year you're going to get WPI inflation only about 1 percentage point average, and CPI inflation is supposed to be around 3.5. So your GDP deflator could be 2.5%. FY25, I think nominal GDP growth has come at 9.8. Even if you take a lower nominal growth of 9%, and if you have a GDP deflator of 2%, you can end up with a real GDP growth of 7% just mathematically for FY26. I acknowledge that there are a lot of downside risks from the global, developments that have been happening. But if you look at the domestic story, April, September, the government would be spending a lot of capex, and compared to last year when they did not do anything, you'll get a very good year-on-year increase in April, September because of government spending. RBI has, infused a lot of liquidity, changed their, policy rates, 50 basis points, another 50 basis points will come. They've changed the macroprudential tightening. inflation has fallen, tax cuts have been given. These are all very positive for consumption going forward. So, and consumption, by the way, is close to 60% of GDP. So if you get this consumption right and government is spending, even if private investment is low, I can't see how India's growth could be lower than 6.5%. If anything, there could be an upside risk as we go forward in the next few quarters. So that's my optimistic take.
That's a neat wrap on all the optimistic factors that are providing a tailwind for the economy. To it, I would also add higher than expected monsoon. And today I had Dr. Ramesh Chand speaking to us, and he believes that he was forecasting that the current year's agricultural growth also will be well over the FY25 growth will also be well over 4%, and he expects a repeat of that, given that the early signs from the monsoon are good. So given all this, yes, there is an upside risk. So we have to take a break, but thereafter my questions to all of you will be, is there an upside risk to your own forecast for the current year? And secondly, should we tone down, therefore, the expectations of more rate cuts from the Reserve Bank? Those questions after the break. Welcome back. You're watching a special edition of Indianomics based on the GDP numbers for FY25 that have just been announced. The numbers are an upside surprise. Both the fourth quarter numbers and the full year numbers are better than the polls thrown up by CNBC-TV18 and other agencies. I've been speaking with economists Kaushik Das, Subhadip Rakshit, Abhishek Upadhyay and Aditi Nair. Gentlemen and Aditi, thank you very much for waiting on, for your patience. Abhishek, first cut, is there a likely upside risk to your numbers, growth numbers for the current year?
We are taking balanced risk. Again, I come back to the global growth viewpoint. This year, exports would have contributed roughly 80 to 90 basis points. The additional growth in the last fiscal year.
That's correct.
FY24 exports growth was around 2%. Last fiscal we got around 6% growth, which was a meaningful growth support. If we see a sharp slowdown here, then it will be difficult to get stronger growth. That said, assuming US economy doesn't enter a recession and global commodity prices stay soft, other factors are more benign clearly. 2 points here. One, we are thinking underlying growth at the start of the current fiscal is 6.5, but it could well be stronger. In the past, what we have seen is whenever the informal sector of the economy is doing well, the tendency for growth is more towards upgrades rather than downgrades, which is possible again. And second, consumption has been the key weak point for us all through, last few years. But what we are seeing now is rural demand, which is the bigger part of the overall consumption pie, has started to do well. And with additional tailwind from, a weaker inflation that we anticipate this year, it is likely consumption growth could surprise higher. Finally, urban consumption, which is more global demand sensitive, but it has some tailwinds, as Kaushik mentioned, from income tax cuts, as well as the interest rate cuts from RBI, which should support that part of the economy. So yeah, the one way I'll put this is the downside risks at this stage appear limited, assuming global growth is not very, very, very weak.
Yeah. That's a nice way to put it. Let's not speak about upside risks when there is still a big global uncertainty. But Subhadip, it'll be very difficult to argue for 4 cuts with such a growth, wouldn't it?
Yes, Lata. Argue for 4 cuts, it depends on the perspective, right? When we say 6.5% growth, from a policymaker's perspective, is it a good growth or a bad growth is a good question to ask. If you aspire for a 7.5% growth, and if you have inflation which is favorable, and when I say favorable, it is below your central target.
A mandated, yeah.
Yes. And then I think that's the point where you try and push growth as much as you can, because eventually a point will come cyclically. And that's the nature of cycles, that you will have to move the other side. But when you can push for growth, when you can support growth, you will work with the inflation growth mix that we have. Now, the point is that if you have a 3.5% growth in FY20, 3.5% inflation average, which is our estimate for FY26. And even if you have, let's say, 1.5% as a natural or a neutral rate, you have space to cut rates. If not by 4, you can have another 3 for sure. But my point is that, whether it's another 75 bips cut or whether it's 100 bips cut, the context is, if we believe that 6.5% is good enough, then maybe 50 bips. But if we think that 6.5% is not what the potential growth of the country is, and the monetary policy, along with the fiscal policy, has to move towards at 7%.
Got it. Sorry, unfortunately out of time, so I'll have to, rush the comments from Aditi and Kaushik. Aditi, take from Reserve Bank, how many cuts?
So Lata, I think we also need to focus on the fact that when we look at the annual GDP growth data, there is a very sharp slowdown between FY24 and FY25. Now, with CPI inflation averaging close to 3.5%, which is our forecast, and several months ahead where we want to have sub 4% monthly prints coming in, I do think that we could be in for another 75 basis points of rate cuts. 50 is, I think, a minimum. 75 is certainly possible at this point.
Oh, 75 possible. Kaushik, last word. You have the last word from RBI.
So Lata, since I'm the most optimistic on growth, therefore I would say only 2 more rate cuts. Okay. And that also 25 basis points in June, after which in August, I expect RBI to pause and they give the final rate cut probably on 1st October in the October policy, where the policy rate comes down to 5.5. Remember that RBI has infused so much liquidity, and with this dividend transfer, your effective easing has happened already another 25 basis points. So in June, if RBI cuts rates, you're probably going to see 50 basis points actual rate cuts because of liquidity. And I don't think you need to go below 5.5 on the repo rate. As I told you before, in 2019 calendar year, our GDP growth was below 5%. That is the time when RBI had cut policy rate to 5.15. Today, we are saying that growth could be 6.5 or between 6 to 6.5. Why should the repo rate go to 5.15? So I think 5.50 is the terminal repo rate.
Fair point. Actually, you're not alone, Kaushik. I think Abhishek shares that point of view.
But with a pause in August, I think people are just doing extrapolation every week.
At the moment, the market also may be on your side, because the bond yields have moved by 5 basis points after the GDP numbers have come. So the new 10-year is at 6.22%. It was at 6.17 yesterday. And the old 10-year, which is really the 9-year, has gone up to 6.25, if I'm not mistaken. So clearly, the market believes that the good growth could put a leash on Reserve Bank's largesse. That's it on this edition of Indianomics. Kaushik, Subhadeep, Abhishek and Aditi, thank you very much for analysing the GDP numbers.